Thank you, Sadia, and thank you to the Guild Board and Library as well for giving us the opportunity to provide some of hopefully useful home buying information. I think I speak for all of us when I say we really appreciate you taking the time to join us this evening on this Zoom call or whatever platform you might be using to be here with us tonight. I know many of us are working from home these days and are probably on Zoom meetings or all sorts of meetings. So we really do appreciate you being here with us tonight and taking the time out of your evening. So thank you so much. So we'll go ahead and get started. Here's some of what we intend on covering today. And as Sadia said, feel free to enter in any questions that you might have in regards to the presentation. We would be more than happy to answer any of those questions that pertain to the information that we're providing today. And I believe Sadia will be monitoring those questions throughout the presentation. Otherwise, we'll go ahead and address those at the end of the evening as well. So we'll start off by taking a look at some of the advantages of renting versus buying. There is some advantages to renting. Limited responsibility, right? So typically your landlord is going to take care of that property. Sometimes you might not even be responsible for paying utilities. Those might be included in with your rent payment. You have very, limited responsibility. So repairs are typically going to be done by your landlord. It's usually just a phone call. Your landlord will let you know when they're available to come on out and fix whatever it is that is an issue. There's also the flexibility of being able to move around. So there's definitely more mobility since it would be a little bit harder to sell your property. Maybe not in these times. I think we were just talking about it before we actually started the webinar, and Kimberly was talking about how properties were almost sold before they're out there on the market. Am I right?
You are. It's a challenging time to catch one, and we can talk about some tips and tricks and finding one later. But it is nice to be free when you're renting, and like you said, you could maybe get your garbage included or your water. And every landlord's different. I know the town of Elgin has really strict policies for landlords. You have to take a big class before they'll let you be a landlord. Mm-hmm.
Correct. Yes. So, definitely some advantages to renting versus being an actual homeowner. So we covered those here. And then, some things that you might want to keep in mind, as Kimberly just talked about, if you did purchase a home and you decided that you wanted to move, maybe that wasn't the right home for you, you do need to know that, the county, the city that you live in may have certain regulations for whether you can rent your property out and how you go about doing that. So you definitely want to know, what those laws are. Know that a rent lease is a legally binding contract when it comes to living arrangements and renters' rights, including, what your security deposit is and what it may take to get that back to you, mm-hmm. Including damages and how rent increases may go through. So when you do sign a lease agreement for renting a property, make sure that you're aware of what your rights are and what you can and cannot do within that property that you are actually renting. Be sure to do a thorough walkthrough prior to signing a lease. So any pre-existing damage, you should have that documented so that, there is no question on whether you receive your security deposit back at the end of your lease. So now let's look at some advantages of maybe buying a home. Definitely, you want to do the math. So For just as a quick example, according to rentdata.org in 2020, the average rent for a 2-bedroom apartment in Kane or Cook County was about $1,250. So I couldn't exactly find what the average cost for a 2-bedroom home in Kane or Cook County were, but I did kind of run some numbers, and if you were to look at a $150,000 home and you were to put 20% down so that you're not paying PMI insurance, your principal and interest payment would come out to about $540. That's assuming that you have an interest rate of about 3.5%. Does that sound about a correct interest rate, Jessica?
It does.
Okay, so this is on a 30-year. You'd be looking at a principal and interest payment of about $540. If we assume $375 per month for taxes and about $125 a month for homeowners insurance, you would actually be paying about $1,040 a month. This is buying a $150,000 home. So $150,000 home might be a little bit on the lower end for Kane or Cook County, but that just gives you an idea. So again, that's $1,040 per month versus $1,250 in rent for a 2-bedroom home in the same counties.
Yeah.
So, yeah.
Something I just want to toss in there is a good conversation to have with your realtor or your lender is, are you looking to buy a single family home or an attached home? Because sometimes the HOA fees, which do include a lot of nice things, they might push your teeter-totter over one way or the other based on your PMI and your tax. So that's a great conversation to have, how far you want to stretch it.
Exactly. And again, that example was assuming that you're putting 20% down. 20% on a $150,000 home is $30,000. I don't know that most of us are putting 20% down on our homes anymore. I did also do some calculations on, let's say you're buying a $200,000 home and you're only putting 5% down. That's going to be a $10,000 down payment. If we assume the same interest rate over 30 years, that bumps your principal and interest payment up to about $850. We're assuming that also your taxes will be much higher. So let's say about $6,000, that's $500 a month. And insurance is also obviously going to increase. We're protecting a more valuable home. You end up with a principal, interest, real estate taxes, and homeowners insurance payment of about $1,520. And now you have to pay, like you said, Kimberly, PMI insurance.
Sure, sure.
PMI insurance on a $200,000 home.
80?
About $80, $120 a month.
Okay, so we're still just over that 12. Well, at that point, you're about $300 over. But at that point, you have purchased a $200,000 house.
Yeah,
So,
and if you don't have 10,000 to put down, you can ask your seller to pay for credits, and it won't necessarily affect your mortgage payment very much, but it will affect the amount that you bring to the closing table. So that's a helpful tip to say, oh, is this house $200,000? Well, you know, maybe it'll be 190 if you help me out with 10, or you offer 210 and they give you 10, then they still net 200,000, but then you're bringing less out of pocket.
And Marlon,
Does that make sense?
those two examples are really great. I like how you gave the example of the 20% down payment and versus the 5% down payment, because a first-time home buyer is not required to have a 20% down. And a lot of my first-time home buyers, they think they need a 20% down. So there's a lot of first-time home buyers that can qualify with the 3% down and not necessarily even like the 5% minimum that most lenders would require from them. So there are programs that would allow them to bring as little as 3%. And as Kimberly mentioned, you can, on top of that, you would be able to negotiate some of those seller credits, concessions that you would be able to work into the transaction.
perfect. All right, so there's definitely obviously some advantages to buying. So besides doing the math and considering how low rates currently are, um, 3.25% for 30 years, right? Roughly. You know, you need to consider, does it actually make sense? Are the advantages more than the disadvantages for purchasing a home, right? So, and for owning your own home, especially if you consider, you know, some of the restrictions that you might have with renting, not being able to do anything to that property because it's not yours.
Mm.
Versus when you're buying your own home, obviously it is your own home. You get to mainly do what you would like to do. But like Kimberly mentioned, if there's no homeowners association, which can sometimes limit you on some things that you might be able to do, or the type of home that you might be considering, a town home, an attached home, may have some restrictions attached to it as well.
Mm.
But certainly you have more freedom to do what you would like to do with your home once you actually own it.
Yeah, I think sometimes pets are a big motivator. In one of my last training classes, they said sometimes people just move because they got a dog and they want a fenced yard, or they need a second dog, and there's HOA limits on how many number of pets you can have. So
There are babies too, right?
yeah,
Fur babies, we love them. So do anything for them, right? So, so as we talked about very briefly, obviously there's you know, some responsibilities as a homeowner, but it's not just a mortgage payment. I kind of alluded to it in my examples. As a homeowner, you also are responsible for your real estate taxes, which can increase. And we live in the state of Illinois, so they're likely going to increase. You're also responsible for homeowners insurance. You're responsible for the maintenance and repairs of that property. And you may also, like we alluded to as well, be responsible for paying what's called PMI insurance, private mortgage insurance or mortgage insurance, depending on how large of a down payment you may or may not be putting down, whether you have concessions from the seller, or maybe you reach out and look for down payment assistance programs. I am not so familiar with them anymore, but I know that there can be down payment assistance programs through the state, through the county, possibly through your employer as well. There's some large companies out there that do offer down payment assistance for their employees simply because they want to maintain those employees and they want them to live closer to work, right? That can be a huge advantage for holding on to a good employee as well. So, you know, the housing market can fluctuate. It's all about supply and demand. And unfortunately, that can delegate the value of your home and how much your home will appreciate or potentially depreciate. Hopefully, we'll never see that again. But we have seen it in our lifetimes. So, you know, it's all a matter of supply and demand and how that housing market fluctuates. So let's take a closer look at some commonly asked questions. So if you don't already have one, the very first thing that I would suggest is start a budget or a spending plan. You know, as we alluded to earlier, there's always going to be maintenance or repairs that are needed when you are a homeowner. So while the equity in your home will likely increase with time and as you pay your mortgage down, there's constantly going to have to be that maintenance and repair account set aside just for that. And this is going to be annual. Something's always going to break down. Something's always going to need to be maintained when you're a homeowner, whether that's, you know, the sod outside, painting, you know, painting on the interior, new carpeting, cabinets, whatever the case might be, there's always something. You know, for those of us that are homeowners or have been homeowners in the past, you likely know what that's all about. So if you don't already have a housing budget, you certainly need to start there. know where you're at with your credit and make sure that you're established with your credit accounts. Before you go get pre-approved or speak to a lender, you should know exactly where you stand with your credit, what your credit score is, how many credit cards you actually have, what loans, whether they're fixed rate loans or whether they're personal loans. You should know all of the debt that's out there, what your monthly payments are, and how much you have in savings. The larger down payment you have, or the larger down payment that you can accumulate, whether that's your savings, whether that's concessions, a down payment assistance program, the more you can actually put down, the less you're going to finance, which means the smaller your monthly payment is going to be. So kind of where you get started is you apply for a mortgage, right? So once you've determined what is affordable to you, you can go out and get pre-qualified. So pre-qualification is really just an approximation. This is not a promise. It's a very preliminary view of all of the data that you've given your lender. There is, and correct me if I'm wrong, Jessica, there's no real verifications. If it's just a pre-qualification, you're just basing your information off of the information that that particular buyer has given you, correct? We can't hear you, Jessica. Oh. No, you're very, very low. But I believe she was saying that is correct. So a pre-qualification is really just based off of the information that you have provided your lender. They're not actually verifying any information with your employer for pay stubs or anything like that. It's just very, very preliminary.
I think once you find your property, then Jessica can lock in your rate and it gets a little more serious.
Correct. So the next step would be your pre-approval. So once you actually have a property, so the pre-qualification, you can meet with a lender. They can give you an estimate of this is, based on the information that you've given us, this is how much we think you could afford. This is the loan amount that you could, borrow. This is roughly what your payment would be based on that day's interest rates, but nothing is really locked. Nothing is really set in stone until you actually have a pre-approval. So you can be pre-approved contingent to an actual property. However, that pre-approval can really change once you actually find that property. So once you actually find a property, you would go back to that lender and say, here's the property that I found, here's how much it's going to cost me, here's how much I need to borrow, and that is now going to turn into a pre-approval. This means they are now going to order the appraisal. It's up to you to order the inspection. They're going to do all of those verifications of your income, all of your assets, any kind of information that you provided on that application. So this is an actual formal assessment of your income and all of your assets. Okay, big bold letters there. Once you are pre-approved, once you have this property, do not apply for any additional credit. Do not change anything in your financial situation because it can negatively affect you and can hold off that final approval and the clear to close.
Teeter-totter thing.
What was that?
The whole teeter-totter thing. I mean, it might just dip your DTI percentage or your ratio one way. I mean, I had to really remind someone once, say, don't order that mattress yet. Don't go trade in your car.
Absolutely. And in my previous life, I was a mortgage lender myself.
Okay.
And I can tell you, luckily only on one hand, but I can tell you there was a handful of times where people would get to the title company, to the closing, get ready to sign their paperwork, and the title company is doing a credit check, a last minute credit check, because that lender has the right to check your credit and verify your credit report up until that moment. And there was people who took out a new credit card at JCPenney because they went and bought a brand new bed, or some furniture store because they went and bought furniture for their new home, and that closing either did not happen or was delayed. So Do not change anything from the time that you were pre-approved up until the day of your closing, and you have those keys in your hand, right? Thumbs
Right.
up, right, Jessica?
Yes, can you hear me now?
Yes,
Oh,
we can
yes,
hear you now.
yeah.
Great, great. So one other thing, co-signing, that's also applying for credit. So don't, you know, if you're in the middle of taking on as a co-signer, you know, postpone it, because that
Okay.
can also hinder your approval. So you don't want that happening, especially at the table.
No. Jessica,
Yeah.
there was a question that came in and it was from Oliver. So if you don't have the chat room open, everyone, you can go down to the bottom and hover and it will open. So Oliver says, is $10,000 a good deposit when purchasing?
It depends on the purchase price.
Hmm.
You know, with $10,000, we would need to meet the minimum required down payment and also closing costs. Closing costs are typically 2% of the loan amount that you're taking on. So it could be a good, you know, deposit, and it could cover most or majority of the down payment and closing costs, but it just really goes down to that purchase price range that you would be looking at.
Mm.
So there are calculators that you can use to estimate what those closing cost down payment would look like. If you do like a quick Google search, you can pull that up. You can also use tools from mortgage lenders. They would also be able to provide you with preliminary estimates of what that would look like. But yeah, it all
And I
depends
think
on
most of our financial institutions have calculators on the website. I know we do. You know, we have calculators on our website that you can go out there and kind of calculate your payment. It can give you, you know, kind of an estimate of what your principal and interest payment would be for a certain loan amount with a certain interest rate.
also an idea of those upfront costs that you would need to cover. That's one of the things that, you know, a lot of buyers didn't see before, where a lot of these items are paid out of pocket and are included as part of your closing cost, where you're paying the attorney fee, the title fees, and
Appraisal.
appraisal,
Mm.
your first year of homeowners insurance.
Mm.
The thing that you don't pay is the service for a realtor. Is that right, Kimberly?
That is right. And not many people know it's free to use a buyer's agent because in the state of Illinois, sellers pay the commission fee. It's nice.
So it doesn't cost anything to have Kimberly come and work for you.
Oh, no. And I have such a joy helping people answer their questions. And when I first met Jessica at KCT, they had moved into the South Elgin branch when I was working part-time at the library doing a children's branch coordinator for kids programs. So I was doing real estate part-time, but now I'm full-time. It is really taking over. So taxes is something I wanted to bring up because I've never paid more taxes in my entire life. But when you purchase a home, the seller pays for that too. They fill your escrow account. You'll see it on the contract. There's at 105%, like Marlon said, they will go up in Illinois. So they account for that and you can feel protected with your first mortgage, knowing that you don't have to come up with a tax payment if you escrow. Okay.
And it's really because you pay your real estate taxes in the rears.
Correct.
So, because that seller has lived in that property, they are going to take care of those taxes, which means they're crediting you, the buyer, for those. So yeah, those are good points, and they all kind of, so it's a difficult question to know whether, you know, $10,000, like Jessica said, is a good down payment, because there's so many things that kind of come into play. You know, you're not talking just for your down payment, but there's closing costs, there's other prepaids that you do need to pay up front. Like Jessica said, you know, your homeowner's insurance, you need to pay a full year up front. So that's part of, you know, it's not an actual fee, but it's something that as a buyer, you need to keep in mind. It's not just that down payment. There's other, what lenders call, I like to call it lender lingo. that lenders call, prepaids and other costs that you need to really think about and consider. There's the appraisal, which are all included in your closing costs, but there's just so many variables that come into play there. So, $10,000, is a 5% down payment on a $200,000 home. But there's other fees that you'll also need to cover, but there's also credits that you'll receive, when you close that might wash some of those out. So everybody's situation is going to be very individual. So I used to always like to say, when it comes to finances, anybody that says yes to you is probably wrong. Because everybody's financial situation is so unique to just them, to that household, to that individual, to your wants and your needs and your dreams and what you want to do, where you see your future going. So there really should be no definite yes when it comes to your finances, not across the board. It should be, that depends on your personal situation. So you should really have people that are going to sit down and talk to you about your specific situation and your specific scenario, in order to be able to answer your questions adequately, I think. All right, so application process. This is just a checklist of documentation that most of your financial institutions are going to ask you for. This is how you're going to get pre-approval. Obviously get yourself organized, because it can be a lot of documentation, but this is how your lender is going to verify all of your assets and your income. So the very first thing that you're going to do to get pre-approval is going to complete an application. And to get a pre-approval, you will need to provide all of the documentation that you see here. That does not mean that your lender is not going to request additional documentation. If you have a pension, if you have Social Security, disability, anything like that, if you've been divorced, if you pay child support, alimony, any of those things that you see here on the screen, you will need to provide those to your lender. And I used to always tell people, be open and honest with your lender. Your lender can pretty much find out everything about you between your credit and your bank statements. Most of us use either a credit card or a debit card. So those are all going to be on either your bank statements or your credit report. So just be open and honest about it. If you have to pay child support, they're going to find out about it. So just put it out there on the application, be upfront about it, provide your divorce decree, because that is where your lender is going to verify that information. Now, because I was a homeownership consultant in my previous life as well, I would strongly suggest that you take the time to sit down with your lender to really review your affordability. Hopefully your financial institution has maybe a preliminary process that they can do before you actually get to your lender, where you can, verify what's on your credit report. They may be able to go over, and kind of do an assessment of, your debt and your income, and tell you, give you an idea of what is affordable to you. If not, I very strongly recommend that you do so yourself. Calculate what is your debt to income ratio. How much monthly debt do you have in comparison to your gross monthly income? Keep in mind as well that your lender is calculating based off of gross income, where you should be calculating based on your budget, which is net income. So what is affordable to you based on your take-home pay? This is after taxes. This is after you've paid your health insurance, or put money into your 401k, or whatever you put money aside for. So you should really sit down and take a look at your needs, and compare those to your wants, and compare those to what is affordable to you personally. So once you've really thoroughly figured out those numbers, You can go and, find yourself a good lender, find yourself a good realtor that will actually take the time to sit down and talk to you and discuss your needs and your affordability.
Mhm.
Typically, your realtors will also have some good referrals for good attorneys and good inspectors. Keep in mind that once you actually find a property and that contract is accepted, you do only have 5 business days to have that home inspected. And then if issues come up with the home, with the inspector, you can, I believe, go back to your attorney and your realtor
Mhm.
and maybe renegotiate something in the contract, correct?
Yes, that's something that's so unique and special about buying a home with, you need a strong team, and the buyer is protected each step of the way. So you've got your loan in place. That's the first part of the process. Then you find the house you fall in love with, and there's 5 different terms that go into that offer. So besides price, it's the moving date, the closing date, it's what's included and excluded. If there's any contingencies, like you'll be contingent upon your financing. And you can also get a home warranty. Sometimes I like to save that for after the inspection and use it as a bargaining tool, because you will get a 45-page report on the condition of the home. And you hear location, 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 right? Well, it's also price and condition and how handy you are. Are you willing to take on a place that needs paint or some repairs? And if there's something that isn't right, the sellers have a chance to make it right in one of 3 ways. They can give you a replacement if it's the water heater, they can repair it, or you can ask for a credit. So there's just lots of different ways to move forward, even though the property isn't as perfect as you thought it would be.
All right. And the mortgage contingency that Kimberly mentioned, Jessica, is, what does that entail?
Oh, well, that just lets the people know that you're not paying cash. There would be no contingencies if you're buying a house with cash, but you're contingent on, maybe you're not selling a house in order to buy one, but you're waiting for all of your steps to fall into place with your lender to get that final approval.
That's correct. Yeah.
Good. So everybody wants to know, how do we get the best rate?
Mhm.
What does that mean? Well, Jessica could probably attest to the fact that there is 4 C's of credit.
Mhm.
These are 3 of them. So your capital, right? This is how much you're worth. This is why they want to see your bank statements for the last 3 months. And this is all of your bank statements, checking accounts, savings accounts, any retirement accounts that you might have, your 401k, anything like that. So this is why you put all of your assets on your application. They want to know your capacity. What is your debt to income ratio? How likely are you to be able to make that mortgage payment? Not just now, but in the future as well. And they want to know, what is your collateral, right? And does that collateral have enough value? And how much are you actually financing compared to the value of that property? And then the last C,
Mhm.
credit, right? We all know credit. We all want to know, what is credit? How do I take care of my credit? How do I start credit? How do I improve my credit? How do I fix my credit? We're all very kind of fixated on our credit these days, and with good reason, because really a lot of lenders think that credit and character go hand in hand, right? This is how you pay your monthly debts. This is how important it is for you to pay somebody that has lent you money. And your payment history on your credit report really talks about how you do that, how important it is for you to do that. So credit and character for a lot of lenders really go hand in hand. Mid-credit score is what they'll use. I believe it's the mid-credit score. So they will pull all 3 of your credit bureaus and use whatever is in the middle of all of those. So, and then a 740 or lower might require some contingencies, correct, Jessica?
Yes.
Okay, so that might mean you might have a little bit higher interest rate than what a best credit score might have, right? Or it might require some additional information from you. You might have to show more assets. You might have to prove those assets. So the lower your credit score is, the more information you may need to provide your lender. The higher your credit score is, the easier it might be for you to actually get pre-approved a lot quicker. And this is really kind of the breakdown of what your credit is all about. So 35% of it is how you have paid all of your creditors in the past. 30% of it is who all do you owe money to? And then 15% is how long have you had credit for? And then that last 20% is what kind of credit do you have? So do you have all credit cards, or have you only ever had car loans? And then that last 10% is, you know, how many inquiries do you have? How much credit have you been trying to obtain, you know, in the last 2 years, roughly? So your credit scores range anywhere from 350 to 850, with high 700s being in very good or excellent credit standings. So if you're in that high 700s, there's probably going to be very few questions asked when you go get pre-approved. But anything lower than that, you know, you might need to provide a little bit more information. Your lender might have a few more extra questions for you. Anything else, Jessica? Am I missing anything?
No, it's also a good thing to point out that the higher the credit score, the more savings you'll see on your rate. So it's always a good thing to check your credit before your lender checks your credit. There are some great apps now and that are completely free that you can track, not necessarily your FICO score, but what it's called, it's a Vantage Score. It's very popular right now, where it gives you an idea of what your credit score might be once your lender checks your credit. And if you see that score under 700, this is the time that you want to, you know, take a look at your credit report to see if there's any discrepancies, anything that you would need to dispute, remove, old trade lines that might have been there for longer than what they should. You can request those to be removed from credit. Also, this is a time where you may want to talk to a lender to see if they can help with consolidating some of that revolving debt, so you can open your credit availability on your revolving debt to improve on how much you owe. That 30%, on what you see, it's 30% of your availability on revolving debt, not necessarily on your overall debt, but they're really weighing out how much of your credit line are you using every month. And if you were to move, for a lot of first-time home buyers, if you were to move debt from revolving debt into installment debt, you can improve your credit score. I've seen it where when, you know, they come to us and we do what we call a debt consolidation loan, where we move revolving debt into an installment loan, we can improve credit scores anywhere, you know, 30, 40, 50 points in a month.
Wow.
So because it's 30% of your credit score. So when you do that one item might put you from a C paper to a B or A paper, where then you can have greater savings on that mortgage. So,
Which means C paper, I might get a 4% interest rate today on a 30-year mortgage, versus A paper, I might get 3.25%.
Well, A paper today would be 3%.
3%. So a difference of maybe almost 1%, if depending on how good or bad my credit is.
Also, a lot of lenders, it's very common that the amount of PMI coverage that they'll need on their mortgage is based on credit score, on that credit rating. So the lower the credit score, the more coverage that they need, because they represent a higher risk to the lender. So instead of seeing $100 monthly PMI payment, they could then see 120, 140 because of a lower credit score. So I'd say any first-time home buyer that's thinking to buy should definitely, this would be the very, very preliminary stages of them thinking of home purchasing their first home to check their credit.
Okay, I have a question for Jessica. When does the PMI go away? How can they get rid of that?
They can request to have it removed when they reach an 80% loan to value. If the buyer or if the homeowner doesn't request it at 80%, the lender will automatically cancel it once they reach 78%.
Okay.
What a great segue, Kimberly. That was going to be one of my points there. So.
All right. Oh, good. Okay. Well, and they just to give that away each month, you know, you really want to know when, put it on your calendar, mark the date, get rid of PMI.
And Kimberly, it's not even about a date. So you can reach that 80%
Well, that's true.
other ways.
Yeah.
So if you've been paying every month a little bit more towards principal, you might reach that 80% sooner than what you're originally were told that it was going to be removed. Also, market value has a lot to do with it. If the values have gone up in the area that you purchase, you can also reach that 80% much sooner than that.
Yeah. Yeah. Is it okay if I tackle a question now? I see one from our program account. I think Sadia sent this in from her email. How will the foreclosure moratorium impact the housing market in 2021? I know it's helped a lot of renters be able to stay in their properties, and for those homes, my last certification was for short sale and foreclosure because they think it's coming, it's coming. I think about 30% of the people in a forbearance plan are current. So for the 70%, if the banks don't really want to be property owners, so they'll be more inclined to let the homeowner maybe add it on to the end. So some of us in the real estate world are expecting a lot of short sales and foreclosures, but others are thinking, well, the bank will help them out in this situation. We'll have to see. And that's, you know, that's the beauty of real estate. You just don't know. It's a daily thing.
All right, very good. So there are various mortgage program options that you should definitely discuss with your lender. Conventional mortgage, as you can see here, just has maybe a little bit more conservative guidelines compared to your FHA mortgages. However, FHA, and Kimberly asked about the PMI insurance and when you can drop it on a conventional. Your FHA does require that mortgage insurance. However, my understanding is if you put at least 10% down, it will drop off after 11 years on an FHA.
Not anymore, Marlon.
Not anymore.
No, on FHA loans, MI, PMI, that's required permanently on a loan. So at this very moment, because of how low interest rates are, we're seeing a lot of those FHA buyers move into conventional loans through a refinance to cancel and remove that PMI from the mortgage.
All right. That's good to know. See, we're all learning something today. And then obviously we have VA mortgages as well. So if you are a veteran, definitely some good benefits to the VA mortgages. My understanding is you can use the benefit more than once or for more than one property. Is that right?
Has to be a primary residence and one VA loan at a time is my understanding.
Okay. And then obviously some USDA mortgages as well. The property must be located in a USDA eligible area. This is more if you are purchasing larger pieces of land. And then we also kind of talked a little bit about when you might want to refinance. So obviously getting out of or removing PMI insurance or mortgage insurance, maybe you are an FHA and it's going to be some time before, you reach that 80%, or in a conventional mortgage, it's going to be some time before you reach that 80%. You might want to get rid of that PMI insurance. Maybe you want to go from a 30-year to a 20-year or a 15-year and try to pay off the mortgage a little bit sooner. Maybe you just have more equity. You haven't refinanced in a while. You have a higher interest rate. So definitely interest rates are very, very low right now, historically low. And I feel like we have said that and we have seen this before. Jessica and I were talking a few days ago, and I said, wow, when I was in the business and rates were at like 4% on a 30-year, we were like, whoa, if rates get any lower, we're in trouble. And she was telling me rates were at like 3% on a 30-year. And I'm like, oh my gosh, how much lower can they go? So
The lowest I saw on a 30-year was a 2.75%.
wow,
Very
Wow.
long ago.
that is incredible. That's incredible.
2.6 was the lowest I saw. Amazing. Oh my God.
That's incredible. So
Yeah.
I really do think that if they get any lower, we're going to be in huge trouble. But I've said that before, so so you never know. So various reasons that you might want to refinance right now, especially if you're over 4% interest rate. This is definitely something that you might want to look into. And then there's obviously some exceptions when you might not want to refinance. So, you want to do the homework. You want to really kind of run the math. For example, if you're in a 30-year mortgage, but you've paid 11 years, you only have 19 years left. Does it make sense to refinance into a 20-year mortgage? It may not, because when you refinance, you're still going to have some closing costs. Typically, for the most part, you're going to have to pay for an appraisal. You have to pay for title work again. You have to pay to record that mortgage again. So while the costs may not be as much as when you purchase, the closing costs themselves are probably pretty similar to when you purchase. You just don't have the additional prepaid fees and other things that are rolled in there as when you purchase. But it is going to cost you most of the time to do a refinance. And you really kind of have to consider, is it worth it to refinance? How long are you going to be in the home for? If you're going to have the house paid off in 10 years, you only have 10 years left. Does it make sense to refinance just to get a lower rate? It may or may not. So, using either those calculators that Jessica referred to earlier, whether it's with your financial institution or going online and finding, calculators that will help you kind of determine that. You definitely want to sit down and do the math. Maybe call your lender that you previously worked for or worked with and see what they have to say as far as the refinancing goes. No matter what, the home buying process takes time, but you need to get organized before you actually go out and try to find a home. So your very first stop should be to put together that budget, to put together that spending plan, to see where you're at with your credit, where you're at with your financial situation. Your next stop could be to go get a pre-qualification with a lender. And then from there, once you're pre-qualified and you've got all your ducks in a row, your next stop would be to go out and find an agent that can help you kind of realize that dream and kind of help you determine what kind of home you may be looking for. Remember, this is the biggest purchase of your life, so do it right, not fast. So other than that, I think that's all we've got. And I think we are good on time. So unless Jessica or Kimberly, if you have anything else to add at any point.
I'm just scrolling through the chat, see if there's any other questions. There was someone wanting to know from Jessica, what kind of grants does KCT accept? That was from Eric. Are there any first-time buyer grants?
So the grants that we accept are the ones that they're not asking for KCT for servicing rights. That's what we're looking for. So a lot of these grants, what they do is that they ask the lender that as soon as the loan is closed, that we sell the loan to them. And right now, KCT is not in the business of selling the majority of the mortgage loans. So we want to be our members' lender. So once you're part of KCT, we like you to stay with KCT. So, you know, that is more common with mortgage brokers or other type of mortgage lenders where it's common for them to do the loan. You'll do the process with them. And once the loan closes, then you'll be transferred to a servicing company where they would service the loan. So typically those grants work that way. You would be working with the servicing company that they choose or that they're working with. So that's all we ask from those grants, not to have us agree to that.
Great. There was another one from Roberto. Any tips on picking a realtor? Yes, it's probably one of the most important things after finding your lender is to find a realtor who is responsive and maybe has been in a multiple offer situation before and knows the tools and tricks to do to help you use your strong position to get to the top of the pile. You want to come in with the least amount of contingencies as possible. If you're a seller, it all depends on seller motivation. So, you know, your realtor, we're usually pretty personable. They should establish a relationship with the list agent and ask. Ethically, they have to answer the questions. So you need to know what questions to ask to find the seller's motivation, like maybe their timeline, you can meet it. Maybe you're in a lease situation, you can extend month to month, or it could just be any little thing. Maybe it's an estate sale and the siblings don't want to move any furniture. So you can say, all right, well, the sellers can leave any unwanted items behind. And then you're dealing with a little bit of a mess, but it ticked off a box on their term. Okay, this is easy. These guys are stronger. Now this is stronger. So your realtor, besides being responsive, should really know the right questions to ask. And every step of the process, you just don't know which way it's going to turn after inspection, after appraisal, even after the title company gets it. Is the title policy clear? Like I've had things where my clients wanted to buy a plot of land and it was in a pie-shaped lot and they couldn't have a pool or a sunroom because the easements ran right across on a diagonal. It was not a good match. And again, you're protected in this process, like each step of the way. It's just great. Your attorneys are great resources too. Something you can ask your agent is how many clients is she working with at the moment, or he? How many buyers or sellers? There's probably a good list of interview questions. You want to know about their team. I like having Jessica on my side because I can literally, text her and call her, Jessica, what's going on? She's right there. So I like that.
Open communication is very important when you're working with the team of people. There's a lot of moving parts. So on a personal level for me, what I would say is tips on picking a realtor would be that I'm comfortable with them, that I can be okay, sending a text message at 7 at night, not, thinking, what is Kimberly going to think if I ask this question? No, I just need to have this question answered. Also for me, what's important is that they know the location. That's also important, that they know the area, they know the market. There's a lot of realtors that their market is maybe, part of Chicago, not really, the Elgin area, but where you're looking at is in Elgin. So a realtor would need to know Elgin for negotiation tactics, for market value, for what your offer should be. Also, I'm not sure how you feel about this, Kimberly, but there is a difference between a realtor that's doing this full time and a realtor that's doing it part time.
Absolutely right.
I like to see more of that full-time realtor. To me, it's it just shows that they're dedicated. You know, this is definitely something they do on a day-to-day. They know the ins and outs, because you do need your realtor definitely on your side and working.
And they're going to be working
you.
to find, yeah, what it is that you need, or
Mhm.
yeah.
You also need that from the lender. You know, that's also definitely something you need to feel comfortable with your loan officer, making sure that they're going to be available in case your realtor needs a question answered, or they request the appraiser on time, that they're getting back to your attorney, that they're available to answer or problem solve. Also, there's a lot of problem solving that goes behind closed doors. A lot of first-time home buyers don't see that. You just need your loan officer to be able to get you to closing.
Sure, and you can even help, loan officers can help a buyer win the house, because if you've got a stack of multiples, the selling agent should be calling all the lenders, and if they don't answer, that doesn't look very good. So Jessica's available, and she can just say and vet you, you know, oh, this is how strong my buyer is, all the ducks are in a row, we're ready to go, you know, the income is secure, all that good stuff.
Yeah, what I like to do, especially for first-time home buyers, is give them my cell phone number. I'm connected. You know, you have a question, feel free to text me, send me an email. You know where to find me. I'm at the Elgin branch. You know, I'm local. It's not just over the phone. So I really like the setup that we have here, where you're just working with your loan officer, and then you know where to find them when you need, if you ever needed to talk to them.
It is. It's important. And like you said, Jessica, you know, both the realtor and the lender, your attorney, it's important that everybody has good communication, and that you as the buyer feel comfortable with each individual as well, and that those individuals work well together. So.
And ladies, there's a few more questions there, so you might want to.
Okay.
I see from Philip, how much are typical refinancing costs?
Typically, they run about a couple of thousand. It really depends on the loan amount. Also, where the property is located, depending on the counties. Some counties have higher fees, but I'd say on average is about $2,500 out there, around there.
Thank you. And then I think we addressed this one before. It was about the foreclosure moratorium impacting the housing market. Just that we're hoping that the lenders will work with the forbearance people and tack it on to the end versus foreclose. Camilla says, how long after Chapter 13 can somebody buy?
That's more individual, because there could be different programs depending on the reason why behind the bankruptcy. So if there's my contact information. If you would like to connect, I can answer that more on an individual level. There's also different programs. There's programs, for example, FHA has a different waiting period than a conventional financing, but typically we would be looking at around 4 years on a Chapter 13.
Okay, and Eric, thank you. Eric says, does KCT require 3.5 down payment as well for first-time home buyers?
So that's also more of an individual question, but typically what we're looking for first-time home buyers under our conventional program is 3% down payment.
Okay, and we've got another one saying someone already took advantage of the first-time home buyer program. Are they still able to apply for it again?
That's a great question. The answer is yes.
Wow.
So, yes, yeah.
Cool.
So for this purpose, anyone that hasn't owned or had ownership interest in the last 3 years is considered a first-time home buyer.
Wow.
So if you don't have a mortgage in your name, or don't co-own property with anyone, and you haven't co-owned property for 3 years, you're a first-time home buyer. You're considered
Okay,
a first-time home buyer.
Wow, wow. Okay. Sadia, is that all for us?
Sorry, I had to unmute. There was also one on, can you let's see. Can you decide how much goes to principal versus interest?
Ooh, if we could.
I know
All
you can
towards
make
principal.
extra payments. Does KCT let you do a buy monthly?
Yes, yes. So to answer that question, yes. So once you know your interest rate, what you can do is then go to like do a quick search on the web for what you want to look for. It's an amortization calculator. What that calculator does, it breaks down the payment for interest and principal and gives you an exact amount of how much will go to interest every month. So if you wanted a certain dollar amount to go towards principal, you'll be able to determine how much money you'll need to increase it by to meet your goal.
And there was somebody asking about, let's see, sorry, I just lost. Should someone with student loan debt over 50,000 wait to buy?
It not necessarily. It really depends on what other debt you have in your income. So that's more of a debt to income ratio, as Marlon pointed it out. You would, what I would suggest is meeting with a lender just to do a calculation on what your debt to income ratio is. Typically, what a lender would like to see is a 45% debt to income, and a loan officer can help you, calculate where you're at now with your student loan payment.
And how about how long after Chapter 7 can you buy?
Typically is 2 years.
Okay.
But
Split up
there's different programs and different waiting periods. So again, everything's more individual. It's more on your specific scenario, and it's also there's circumstances that can reduce your waiting period or increase the period where we would be able to secure a mortgage for you.
I think that's what makes KCT a little unique, is that they don't sell their mortgages to other servicers. They look at you as a person, they look at your whole picture. And, if anyone's met Joe Menesolino, he knows what a big heart he has. So come on into the branch.
Yes, yes.
How about any advice or information on down payment assistance programs?
King County used to offer, I don't know if they still do, but King County a few years back used to offer a down payment assistance program. Try Googling King County Down Payment Assistance Program. It's usually for first-time home buyers only. Again, if you work for a larger company, there are many large companies, and it may be, they're going to give you $1,000, $2,000, $3,000. But a lot of the larger companies do offer down payment assistance programs as well. I would start with your HR representative and see if that's the case.
Marlon, also a good resource is Illinois Housing Authority, also known as IDA. That's where majority of the people I know that are first home buyers are looking for grants. They have really good information there regarding the type of grants that they offer, but it's also where you're buying locations. So King County might have, different grants that if you were to buy in DuPage might have their own, program. So it also depends. But what's great about down payment assistance is that also your realtor knows where to find these, and also when you have a down payment assistance grant, you also want to work with a loan officer that is an expert working directly with these organizations to make sure that they're meeting their guidelines, because now you have two set of guidelines that you would have to meet: the lender guidelines and also your down payment assistance program guidelines. So you want to make sure both are met.
Because they won't necessarily match.
No, that's right.
Heavily regulated process.
Okay, thank you so much, ladies, for all your wonderful information provided. If we missed anything, again, all their email addresses are there on your screen. So feel free, I guess they can contact you guys for any questions. And
Definitely.
we have this program recorded, so it will be on our YouTube channel if you'd like to watch it again, if you missed
Share it
anything.
with a friend. I'm always saying that. Tell a friend.
And again, stay tuned to our, keep checking our website. We're always coming up with more virtual programs. And I think that's it. So again, thanks for joining, and thank you, ladies, for putting on this great presentation for us.
Thank you
Great to be
so
with you.
much.
Thank you so much. Have a good night.
Have a great evening, everybody. Bye-bye.
Bye. Bye.